Дякую, Антоне. Доброго ранку, шановні пані панове. Ladies and gentlemen, I'm delighted to see you all here this morning. Let me first thank our hosts, ICU, for their kind invitation to be involved in this forum. It's my great pleasure to introduce my next guest, a renowned economist, founder of the Ashmore Group 20 years ago. He has lectured at Oxford University, worked on aid issues in developing countries, and also advised the UK government. In fact, they probably need him today more than ever. Ladies and gentlemen, his enthusiasm for emerging markets is infectious, and we will see if it has been dimmed by recent events. We will talk about groupthink and fear and how we can learn to appreciate emerging markets once more. It's my great pleasure to introduce to you the chairman at New Sparta, Dr. Jerome Booth.
Thank you very much. Well, what I'd like to talk about today in my title of my speech also has the word madness in it. We are in a mad world, and I've chosen that word in the same sort of way that Einstein referred to madness, which is doing the same thing again and again, expecting a different result. And I feel we've got ourselves into a rut in terms of global allocation and policy. And I think we're facing, unfortunately, some of the same risks that we were facing 10 years ago, and we haven't done anything like enough to prevent another crisis. So I'm going to talk a little bit about that. I also want to talk a little bit about denial. I think I wrote a piece in 2011 about the 5 stages of grief, the Kubler-Ross stages of grief, the first of which is denial. And I still wonder whether we've actually got out of that first stage. There's a little bit of anger coming up now, a little bit of bargaining, but really we're still in denial. I think we're in denial about the state of systemic risk. I think we're in denial about the global imbalances. I think we're in denial about how to do asset allocation well, and we're in denial about the role of emerging markets in the global economy and how that should be represented in asset allocation. There's also a huge amount of prejudice. I think prejudice is everywhere. And I came up in the book that I wrote 5 years ago with a sort of terminology. I call it core periphery disease. And it's a disease in the sense that it's a sort of meme lodged in our head. And the idea is that the core, that is United States, Western Europe, can affect the periphery, but we can completely ignore the effect of the periphery on the core. And this idea has been around for a couple of hundred years. It's a deep-seated meme, and we have to battle it. We have to challenge that idea. We have to rethink a lot of our ideas about how the world is structured from first principles if we're going to really understand the structural problems in the global economy and therefore what to do about them. We start, however, the big problem, as Keynes said, we are all hostage to the ideas of some dead economist, whether we appreciate that or not. We start with finance theory. Finance theory, the basic thesis of my book is that finance theory is not fit for purpose, and its inappropriate use has caused huge distortions in global asset allocation, affecting hundreds of millions of people, both in the developed and the developing world. And it's just morally wrong. We have 2/3 of the world GDP in emerging markets, and we are still disparaging about them. We associate quite ridiculous ideas about risk with emerging markets, and we have to completely turn that upside down. We have to rethink a lot of that things. And I think the problem started way back in the 1950s. In 1959, Markowitz came up with a book which is over 300 pages, very, very famous. And in it, he says that the movement of a stock really can be explained by 3 things. The idiosyncratic, he calls it risk, he means volatility. The idiosyncratic risk, the co-correlations or covariances between different assets in your portfolio or in your asset class, and the overall correlation to the index or the whole. And then he says, in one line, but for computational convenience, we'll ignore the covariance with all the other stocks. And this way, we will just explain movement in terms of idiosyncratic risk, that's the risk which is uncorrelated, and the movement of the index, the asset class as a whole. And from that, that's our first major mistake in our thinking about how assets behave. Of course, if you've got, say, a bunch of coal miners in your universe, and something happens to the coal price, they will all move up and down together. So that sort of movement is ignored. It's assumed to be just not there. And he did this before computers, sort of thing. So this was in the 1950s. So there was maybe an excuse for doing it then. We're also taught at business school that if you, when you build a portfolio, you randomly add assets into the portfolio. Then by the time you get to about 15 assets, you can't really get a lower volatility than the index. The key word that I slipped in there was randomly. If you don't select them randomly, of course you can. It's very, very easy. In fact, the first job of an asset manager is to avoid big risks. I remember very clearly in the late 2000s, 99, that sort of period, when it was pretty obvious that Argentina was going to default at some point. In fact, I would go so far to say that anybody who didn't know that had no business as a professional in our industry at all. It was that obvious. We didn't know when, and it was 25% of one of the indices, 20% of another, and it was that high because they'd been selling bonds into massively, because they were in such difficulty. They issued more and more and more debt, so they'd become a bigger part of the index. So the very simple thing to do was to just not have any Argentina. That way you had a much better performance, lower risk. And this, by the way, is a very good argument against passive investing. Passive investing, I always think, is a bit like driving with your eyes closed. And the logic behind that is that it saves your energy. Yes, it does save your energy, that's true. You can save fees by passive investing. It's also much more dangerous in certain conditions, because the index can be much more dangerous than an actively managed portfolio. So I hope I'm challenging some conventional wisdom here, the first of which is that the index is not the lowest risk thing you can do at all. You can do much better than that. But there are other problems with risk. Risk is actually very difficult and very complex. Volatility, past volatility, is relatively easy to measure, so we just confuse the two things. But risk is very, very complex, and it's actually different for different people, because we have different levels of information, different liabilities, different needs in a crisis. We may not have to sell into a sudden sharp drop, or we may have to sell. We may have behavioral problems, behavioral biases. We know a lot from behavioral finance now, but it doesn't seem to have got much into the ways that we allocate. Certainly the sort of, up till about 10 years ago, the 2009 David Svensson book on the Yale model, which is a great improvement, if you like, on the previous way of thinking about asset allocation. He argues strongly for less liquid assets, for diversification, for the whole argument moving away from this very simplistic world, which was you just do stuff in the US and Europe and you have fixed income and you have equity. He was moving beyond that. But he still said, of course, one shouldn't allow traders to get their behavioral biases in the way. So one should only think about strategy once a year. And that may sound sensible, but if you're in Belgium in 1939 and the Nazi tanks are rolling in, You don't really say, well, actually, I haven't got my investment committee for another 6 months. You just basically grab everything that's not fixed and you run. You change your strategy. And I think there is no excuse for driving blind. I think there's no excuse for not thinking. And what finance theory has enabled us to do is to sort of wander blindfolded into a world which we no longer understand because we're not thinking, we're not awake, we're not concentrating. Risk is also very different from uncertainty. Frank Knight, one of the founders of the Chicago School, and Keynes didn't agree on very much, but they had a very similar definition. So Frank Knight says that uncertainty is where you have one-off events. It can be expressed that the difference really is that when you have random events, if you know the probability distribution, that is risk, as opposed to uncertainty where you don't. And once you know the probability distribution, you can hedge, you can insure. And this, of course, led to Keynes's great insight, the general theory, which, apologies to Keynes, can be explained in one sentence, which is that where there's a lot of uncertainty, this massively decreases entrepreneurs' willingness to invest in plant, and this creates unemployment, which creates more of the same, and a vicious circle, and you get depression. We have a world which sort of assumes away uncertainty and really just focuses on risk, and then focuses on risk in this very simplistic way. Doesn't understand that people's liabilities are different. Oh, and there's another thing, liabilities. Do we understand liabilities? Not really. One of the big impediments to our really understanding our own liabilities is what we call money illusion, what economists call money illusion. This is the illusion, in particular, that a currency is somehow fixed. So you hear a lot of talk in the media about how emerging market currencies have all come off. And they've all come off, obviously some are worse than others, Argentina, Turkey, but the rest of them have all sort of come off by almost exactly the same amount. Well, if I was, say, standing on the top of a hill and I saw this bird flying, I'm going to call it an emergent, this bird, and I noticed that it's a pretty unstable thing. It's sort of bobbing up and down, and I'm thinking, well, that's due to either poor navigational skills or an external shock, bad weather, but it's something to do with that. And then I notice, actually, there are 50 of these things, and they're all moving up and down together in the same way. So I can either think, well, wow, all these markets are really risky. They are, completely mismanaged. And then I have a sudden revelation. And the revelation is that I'm not on a hill, that I'm actually standing on the deck of a ship. And it's me that's moving. Is it the dollar that's gone up, or is it emerging market currencies that have gone down? Is the dollar a price like any other? Yes, it is. Any currency is. When we're thinking about liabilities, that also has a huge impact on the way we think. So if we live, take my country, the UK. The UK is an open economy, possibly about to get much more open. It has maybe 50% of its economy basically is tradable goods, it's linked to what goes on in the rest of the world. If 90% of all the cars in the world are produced and sold in emerging markets, and they are priced very competitively such that they become like a commodity, if you like, then we can say that the price of cars is set, not just it's actually set in emerging markets. And increasingly, not just in commodities, but increasingly in goods markets, emerging markets collectively are setting global prices. And that means that if you're sitting in a pension fund in the UK, and your pensioners, when they retire, want to be able to buy a car, then their liability, expressed in purchasing power parity, which is what matters to them, not the amount of pounds that they get. I mean, if there's a bout of inflation like the 1970s, they may get £2,000 a month, and that'll buy them this bottle of water. And they're not going to be very happy. What they want is purchasing power. So once we get rid of the nominal thing, the money illusion, we start thinking about purchasing power as the benchmark of our liabilities in the future for long-term savers, we have this revelation that there's a global economy, and if we don't invest in the emerging markets, we are gambling away from our liabilities. This is a function of money illusion that we think otherwise. So we have to start rethinking a lot of things. We have to start rethinking our ability to manage risk into non-risk, because we can control a company or get out quicker than others, or not. We have to recognize our own limitations, our own knowledge base, our own flexibility, our own liabilities. And that gives a very, very differentiated view of risk. It's complex. On top of that, we know quite a lot about macroeconomics and politics and history. So why don't we use them in asset allocation? We should be using these things. We know a lot. If we just extrapolate from past data, we are missing, in particularly, we're missing structural shifts, the big moves. So, there's up to a certain age when you're a toddler, if you take a toddler and you close the bedroom door and they can't see their bed anymore, they don't believe it exists because they can't see it. There's a sort of mental development stage. We eventually sort of overcome that. We seem to, however, not have done that in financial markets. If we can't measure the volatility, we assume it doesn't exist. If we can't be certain, if we don't understand emerging markets, we just assume that they're risky and we ignore them. And that's not intelligent. It's really suboptimal. Particularly as the global imbalances building up through the Great Moderation, leading to basically a flood of excess savings in Asia, flooding into the US, pushing down yield curves, creating bubbles. You can't understand that unless you understand emerging markets. You can't understand that actually unless you go right back to understanding the history of the international monetary system and how the reserves were built in the first place and why they were built in the first place. And I haven't really got time to give you that whole history lesson, but there are parallels here between the situation faced in the early 70s and the build-up of these huge reserves. They have moderated a bit. The risk is not as dire as it was 10 years ago, but there are still other risks out there. Beyond finance theory, we have also another problem, which is there's not just risk and uncertainty, there's also now fear. And fear channels one's thinking also into very narrow models of the world. Pascal Bruckner, the French philosopher, has written about this, nothing to do with financial markets in his case, but he talks about the need for us to believe in a catastrophe. I also happen to have a film company, and one analyzes the pattern of moviegoers, and horror films are very popular. And they're popular because for people who have this sort of undefined fear about life, for those 2 hours or hour and a half that they're watching a horror movie, they've got good and evil, and actually this is true of the Marvel comic films as well. They've got very simplistic good and evil, which concentrates their fear, and for that period of time, they don't have to worry about anything else. So, and we have this need, post-Cold War, post-other bogeymen we've had in the past, for something to worry about, which is big and ugly. And what we've started to do is we've channeled our views of, if you like, the conventional view of how we look at the world. Partly because I think we're too frightened by the alternatives. We can think about Italy as a good case. Italy's bond market is pretty obvious, has some major problems ahead, some major challenges which make the debt dynamics in every emerging market look very manageable, without exception, I would say. The consequences of Italy not being able to pay its debt are enormous. There are, of course, options. And we have precedents. Actually, there's a very good one from Argentina, where you simply introduce parallel currencies, and you say you're going to be in the euro, of course, but you happen to pay government employees in a new currency, which is, of course, completely compatible. And then, of course, as we know, bad money always crowds out good, and we have a problem. But there are a series of macroeconomic problems in the West which are, if you like, not priced in, not fully appreciated. Because we fear what might happen in Italy, any excuse to discount that fear, ignore it, is sort of grabbed. And I'm not saying Italy's going to have a problem. I'm just saying it might. And the probability, even though it's small, when you combine that with the likely impact, makes it serious enough for us to really think carefully about, if that scenario happens, how are we going to react? Where do we need to be invested to avoid a problem? How are we going to recover from that problem? And we don't do that at the minute because we'd rather just ignore the problem. We'd rather ignore the big problems that we don't want to think about. And we encourage each other to do that. Groupthink is, as an idea, has been around a long time, and it's really about this willingness for us to have this sort of collective thinking, which ignores alternatives. And the way that you can identify groupthink is that people who don't believe that main view are belittled. There's no debate. They are just written off. They are derided, and there is no argument. There is no debate. That's groupthink. Science, according to Popper, is a very different thing. Science is refutable hypotheses which are testable. That's science. So if you've got an idea, you can test it. You know, in theory, if certain empirical evidence comes back, that will falsify it, and you do test it, and it doesn't, you've got something which is scientifically proven, as we say. And there's a lot of areas of thought which is completely non-scientific. It's medieval. It calls to other forms of knowledge, from the written word to authority to history, habit. That's not science, and that's not progress. And I'm afraid to say a lot of our thinking falls into that category in lots of different areas. I mean, you can think of lots of examples. We have also another problem with fear and groupthink, which is the speed of change. So Socrates complained about the written word. And of course, we know about Socrates only through Plato. He complained because he thought it would wreck people's memories. And the tradition of reciting the whole of the Iliad and the Odyssey. Later on, there was huge complaints with the printing press, destroying people's ability to concentrate and listen. Similar sort of pattern. And then we had, if we only go back to the mid-19th century, I would remind us that we had politicians. Gladstone, in his great tour in the United States, we had debates between Lincoln and his opponents, and they would go to some small town in the Midwest, and they would have a 6-hour debate without any notes, talking in perfect paragraphs with meal breaks. And not only would they be able to do that, but the audience would listen without taking notes, and they would have that ability to concentrate. And then along came the telegraph, came the newspaper, the invention of the crossword, just as a means to test this newfangled thing called the telegraph. The fact that you could know what was happening the other side of the country in minutes was just such a novelty. And now we have a similar problem. We have people have difficulty actually just sitting and reading a whole book without distraction now, because they get distracted by other things. And people who can still do that are called that's called deep reading. And we also know, because we now have scientists that look at the brain, that the neurons in our brain are being restructured by the internet. And it is being impacted. The way we think is impacted. And so everything has become much faster. And it becomes even more difficult now to fight against groupthink, against memes. We know of course, that negative news, false news, travels through the internet with a much, much faster replicative, it multiplies itself much, much more than the truth, and that's a major problem. And we have to, as people, as thinkers, we haven't really managed to cope with that yet. We have to constantly check our sources, and we've got to start doing that in all our walks of life. It's a real problem. I'm chairman of a university, and I come across this a lot. What are universities meant to do? They're meant to train people to think, and we need to start doing that. We have, today, I'm thinking back 20 years. I'm going to talk a little bit about emerging markets. 20 years ago, we had, I would say, 3 types of systemic risk. We had, so I'm not talking about a single country problem. That, in a portfolio, you can just ignore that country, not a problem. But there were 3 types. One was a sort of all emerging market problem. So a problem would occur in one emerging market, and it would affect all the other emerging markets. It wouldn't affect the developed world very much, but it would affect all the emerging markets. Now, why would that happen? Well, as Tolstoy says in Anna Karenina, all happy families are happy in the same way, and unhappy families they're all unhappy in different ways. Emerging markets, I rather think, are much more heterogeneous than the developed world, much more. So why on earth should there be this sort of contagion? And the answer was that before 1998, and not since, in any serious sense, they had 2 problems. One, they were vulnerable to external shocks because they had a huge amount of their saving space was external. And secondly, a lot of that money, a third of it was sort of hedge fund money, another third was levered by banks, and so it's highly levered. And so you've got margin calls. Problem happens in Russia, Brazil's fine, but you need to meet your margin call in Russia, so you have to sell your Brazil bonds. That's contagion. That stopped in 1998. That's 20 years ago. And then we had the 2 remaining forms of risk. A risk that can start in emerging markets, become a global problem, or, if you like, a problem which is just starting in the developed world and it is a global problem. And I think we are left with possibly only the last of one of those, possibly the 2 of them. But in a way, the risk has really shifted over the last 10 years to be most of the problems are, I would say, most of the leverage problems. And I'm not that worried about China. We can have maybe a longer discussion about that, because it's got a 50% savings rate. And there are some real advantages in their arsenal of tool set. But there is a possibility, of course, that they upset markets. We also have 3 warning signals for a systemic crisis. First is a homogeneous investor base. So groupthink, fear, use of too much finance theory, creating a simplistic view of the world has added to that problem enormously. We had the tick data from the United States out a few days ago, and it's worrying. Who is buying US treasuries? It's not, Russia sold 90% of theirs. It's not Japan, it's not China. It's US institutional investors. So you've got a problem in the country, maybe, if we think there's some risks out there of extended asset prices, shall we call it. That is becoming a bigger problem. And we need to start thinking not simply about risk in terms of the traditional volatility, but the homogeneity of the investor base. That is something we could measure, we can measure. And not only that, but the behavior. I don't mean this one, this is defined by being a bank or being this sort of institution, but by their worldview. That's what's going to define whether you're homogeneous or not, whether you're all likely to behave in the same way in a crisis. Second criteria is that worldview happens to be wrong. That's the second condition, which is possibly going to lead to a problem. And the third, of course, is leverage. And the leverage has moved around. It's not so much in banks, but it's actually greater than it was up to 2008. So we have problems. We have risks. We have risks, obviously, which I haven't spoken about in in Italy, we've got Bavarian elections, which could topple Merkel. We've got all sorts of problems in the developed world. We have this extraordinary monetary experiment, which has basically smothered things and distorted asset allocative efficiency in economies. And it's a great experiment now to see. It's a big risky period when as we raise to normal conditions those interest rates. So I'm really have to sort of wind up now. The consequences for one's investment strategy. Primarily, the first thing I would like you to take away is we've got to stop thinking about this sort of simple scale of risk, where we think that risk is one simple measure, and you've got things called risk-free. Well, that's an abuse of the English language, by the way. There is no such thing as a risk-free investment. And then everything, above it. And by definition, this is core periphery disease. By definition, emerging markets is always and everywhere riskier than, say, US Treasuries. Think about that for a moment, and you'll realize that's complete nonsense. There's nothing written in stone about that at all. And given that we have big structural problems, given that there may be structural events which are not going to be picked up in volatility, past volatility, and those are the ones we really should worry about, because they're the ones that could wipe out half our portfolio, we need to use some scenario planning. We need to think strategically. We need to think through some alternative realities, and then ask ourselves, are we going to be positioned for that? And what that means is that having also thought our liabilities through again, what they are, we need to be invested in emerging markets. We need to be invested in emerging markets to a much larger extent. And not because we like risk, but because we want to reduce risk. Emerging markets has a place in one's portfolio to reduce risk. And when you start thinking about scenario planning, that is the concept, the one I want to get across, if nothing else. Finally, people ask me, well, what's the point of having this term emerging markets anymore? It doesn't describe a homogeneous group at all. But I like it, because what it does define is our collective prejudice. And prejudice of the worst type, by the way. And my definition of emerging markets is this. All countries are risky. The emerging markets are the ones where that risk is priced in, where it's perceived, where it's reflected in the bond price, sometimes over-reflected. And the developed world is where that risk is largely ignored. And that's fine whilst everybody thinks that for a while, but that's potentially blow-up territory. And we will stop using the words emerging markets when the developed countries start being perceived, and the risk in those countries starts being perceived in exactly the same way. And the same criteria are used to assess sovereign credit risk in a developed market and a developing market. Thank you very much.